For more on what it all means for investors and the economy, Rebecca Patterson, Director of Investment Research at Bridgewater, joins us. Rebecca, how do you think about the impact to growth, not knowing whether it's going to take months or years for these projects to start? What's it going to mean for our economy?
Yeah, I think you just made the key point there, years. So the net increase in government spending here is probably closer to $540 billion, but it's still a big number. What we've seen, though, as we've looked at targeted fiscal spending in the U.S. and other countries over the decades, things like the highway bill in the 1950s, defense spending in the 80s, is that these stocks that get affected the most by the bill, they tend to see a positive flywheel effect because the stimulus starts and then it continues for years. And so the outperformance can last quite some time, even after the initial pop. So this is going to be an opportunity, I think, that investors can take advantage of, not just for the short term, but looking out further ahead.
What about implications, if any, for inflation, which is such a sensitive topic now for the Biden administration that they're going to have to deal with when it comes to trillions of dollars of spending?
Yeah, absolutely. That inflation has been the thing we've been highlighting throughout this year as the key risk for investors. And, we've seen infrastructure pass now. We've got the U.S. Innovation and Competitiveness Act going through Congress. That's another, I believe, $250 billion. Yes. And then, of course, the reconciliation bill. And what's striking is that all of this money and credit is coming into an economy that's already incredibly robust. A demand shock we're really seeing in the tightest labor market in decades. And that nominal spending meeting basically fixed supply means inflation. So what can policymakers do? What we're doing as investors is making sure we're positioned both for inflation that's higher and more persistent than expected, but also the possibility that the Fed has to play catch up. So looking for higher U.S. Treasury yields, but also holding things like commodities, like inflation-linked bonds, looking for companies that can pass through those higher costs to end users and protect their margins. So we're trying to protect ourselves against both outcomes because we're not sure at this point how much of each we're going to get.
Rebecca, is there now a higher chance that the Fed does have to play catch up than otherwise? I don't know how we exactly define that, but let's say have to start hiking rates as early as Q1 next year.
Well, the Fed so far has tried to keep tapering its asset purchases and actually raising rates distinct and separate. And so the market right now pricing in 2 hikes in the second half of the next year goes in line with that thinking. And we'll just have to watch what Chairman Powell and the rest of the FOMC says between now and early next year. I think they want to preserve optionality as much as possible. The pandemic is such an unusual shock. The policy responses have been extraordinary. So exactly how long does inflation stay up here depends in part on how quickly labor comes back. Treasury Secretary Yellen mentioned that over the weekend. She thinks inflation could come down if people come back to the labor market quickly. Our view has been, though, that the labor supply is so incredibly tight. Wages have to be the thing that pulls people back into the market. So you have higher wages, you have higher rents. Those things are going to be pretty big drivers of inflation and more persistent. So we think at the end of the day, there's a decent probability the Fed is going to have to catch up, tighten faster than what the market's pricing in. Whether that starts before the middle of next year, I don't know. But over the course of 22, 23, and so on, I think assuming that you could get more tightening than expected is a good way to be positioning right now.